April 26, 2019, and it's 9:30 a.m. in London when I'm recording this market update or when we're hosting this live webinar. If you're new to this is a webinar we host at the same time here at the ATFX YouTube channel at ATFX UK. So we're going to take a look at the markets. We should be live. Also, the chat box is live. If you do have questions, just put in your questions here at the chat box, and or say good morning or something. As well, don't forget to get those likes going. 0 likes right now, so let's get those likes up and running, and let's get this presentation trending. Okay, good. Let's begin, and we're going to start out with looking at the euro as we usually do, and looking at this from a daily chart. So the market is doing stabilizing a bit, which I think is fair. You know, had a bit of a decline, and traditionally, when you have a break, either of a shorter sort of descending triangle like this one, or a bigger one like if we treat this like a big range, we tend to have some sort of a corrective move, and that could mean that the euro dollar could potentially go back up to the breakout point at 111.75. But as you can probably guess, a lot of the people that were buying here just ahead of that low, when the market goes up to this level, they're gonna be quite thankful for that and probably gonna say, oh look, I'm back at having a relatively small loss. And I think at that point they will probably try to get out of the position, which means that we may go up, but as we start to go up here, there's probably going to be a ton of people selling, and then you're going to have a pushback from that level, and then the market continues to trade lower. I could be wrong as well, and that's why we have stop loss orders. In fact, most traders, they're right about 60% of the time. So 40% of traders are losing traders, and the other one, 40% of trades are losing, and 60 are winners. So the key here, because we're so close to the 50-50 level, is to make sure that your average profit is at least as big as your average gain, if not slightly bigger. And if you're using a trend following system like I am, and trading a descending triangle like this would be part of a trend following system, it all builds on the idea that when we have a profit, it's going to be a big profit, and when we have a loss, it's going to be a small loss. So on the break here, as you might remember, and we talked about this before it happened, I said that on a break to the downside, we may reach this target down here for a profit of about 258 pips versus a risk of 56. Now 258.4 over 56 gives you a residual ratio of 4.61. So this is rather typical here again, and this is typical trend following trade here, looking to get much more and in the gain versus the losses. But that means, of course, because we have a tight stop loss, that it's more likely that we're gonna get stopped out, and that's why for our trend following system, we're actually right maybe slightly less than 50% of the time, closer to maybe 45. But the key point here though is that when we win big. As for GBP versus the USD as well, we had that break already a few days ago here on April 23rd, and the market is stabilizing, a bit of a corrective move. But I think as soon as we start to reach, and that is if we reach 129.58, which is sort of the low here from March, I think people will try to short sell. And there are different ways of dealing with this, and in regards to the stops, I think, and you know, the original stop loss was here, and then I pushed it lower, and I'm just looking at this, and I'm just gonna be a bit careful. Sorry for that. So I'm gonna actually, I think, below 130, and I say sorry because yesterday I said that we can probably lower it to 129.80. I think it's better not to be too close to the price action. Now that is if it goes up, which again wouldn't be that surprising. We're up to this little area here, starting from 29.34 all the way up to I think 29.67. I think people will be quite keen on selling there. As for the dollar yen, the market, as you know, was trading in this inverse head and shoulders. This is a 4-hour chart. The market tried to activate this pattern already here on the 12th, and then on the 24th tried again, but that failed. Now, if you look at this, it's still some sort of a head and shoulders. It's just maybe not that the breakout is here anymore. We can treat this just like a horizontal line, and there's nothing wrong, and sometimes you will have that, which is multiple right shoulders, or multiple, actually multiple right shoulders, even multiple left shoulders, but usually multiple right shoulders. And even if even if we don't treat it like head and shoulders, it's quite clear if you take out a high that we're probably gonna go slightly higher, right? At the same time, if we take out the low, we can probably trade a bit lower. The benefit though of this is that it is the head and shoulders, and the number one benefit of that is that it gives us this target. It gives us an idea of how far we could reach. So per the new head and shoulders, which this is formed to, on a break and only on a sort of a close above 112.18, though I think this market can go upwards. Gold prices, they're up above that breakup point, and this was the breakup point on April 16th. Market went down, and you can see here that the market traded sideways for about 5 days. I think 1, 2, 3, 4, 5, 6 for 6 days. So especially if you look at 4 hour, we had a nice solid resistance level here, and you know, for me that was short on the breakout, and I also shorted a bit more down here. It made perfect sense for me, at least for the first position, to put that in a slightly break even, slightly profit level, and then I added a little bit more of risk here. Now, most of the time, if something's gonna work out good, it tends to work out good from the really beginning. Price doesn't hesitate as much as it's doing here. A bit like the dollar yen, it was hesitating quite a bit, as you probably noticed, and nothing really happened. So that's why I have stop loss orders very tight, and at least for me, I got out here. Now, when we're looking at this today, with no position and nothing really, no view, or sorry, no emotions and no money attached to this one, you know, I'm thinking, okay, maybe we'll have a bit of a swing to the upside and then go lower, because if we use like sort of a traditional trend, the traditional definition of a trend, we're still creating lower and lower highs on the daily, right? And we need to take out that high up here before this is a truly bullish market. As well, this is what we call a very hard retest. Now, we're still below that trend line of this head and shoulders. I think even if we do like that, we're pretty much at that trend line. And not only that, we are still below this level here, which is the is that bearish candle on the back of this breakout. So this, because we're not into the actual head and shoulders pattern again, because we're not back into this one, we can't really reject the idea that it may go lower. And again, this is a very hard retest, but as long as you're below that level, you know, the market could potentially go lower here. So especially if you look at all the other markets, like the Eurodollar, which is also bearish. As for crude oil prices, you know, if you were looking to buy, this is the time. The market, as you know, moved gapped higher as they opened for this new week, and then sort of lingered around the highs. And I said that's not what we want to be buying. We want to be buying here. We touched that buy zone already yesterday, and the market continues to be bullish above 63.43. And I do think that as long as you're above this level, the market is probably going to be bullish. So if I'm gonna be doing anything, I think I'm buying here. S&P 500 moved down a bit, not enough though to hit that new buy zone. As you know, we said down here, look to buy and look to profit up here. The market is moving away from that take profit area and it's not pulling back. It's sort of struggling to create a new 2018 high, but I think it's going to happen sooner rather than later. As well, we will probably have some sort of a bigger correction at one point, and I think when that happens, I think people are gonna buy, unless there's some sort of very bad data coming out. German DAX, as I've been saying over the last few days, probably here, I think it would make sense to take a book a bit of profit, unless you want to keep it for that very strong move. These moves happen. But it's not always they happen, but taking some profit up here is not bad. I think as well, if people want to buy, I think they will buy, wait for some sort of a pullback. Just a pullback. It's a bit like gold, crude oil, which was at the highs and then pullback. Okay, I think we are good with the general market overview. I'll see if you guys have any questions. Um, if you don't, I think we're gonna wrap things up. We have Marvin here. Good morning to you, sir. I'll be doing well, and thanks so much for all the likes and all the retweets on Twitter. It's much appreciated. Um, if you have any questions, Marvin, just put it here. If anyone just want to say good morning or something like that, put it here as well. I know it's not a good morning everywhere in the world for everybody watching in the Far East and places where it's not morning. I guess good afternoon to you guys. And I hope you guys have a very, very good weekend. Let's see what happens with the markets in general. They're a bit quiet, without a doubt. But hopefully we'll see some more action. And it's easier when the markets just go one direction and it goes really straightforward. I remember 2014, a very, very good opportunity here in the euro versus the USD. And then there's been other markets as well, like AUD, USD, and things like that. It's been working really good, even with stock markets like the Dow Jones and all the other stock market indices. Just after Donald Trump was elected here. Got a question. Can we take a look at the dollar, Aussie dollar? Sure. Let's take a look at the Aussie dollar. I'm going to take a look at the Aussie dollar and not necessarily the USD AUD. I hope that's fine. So this is the Aussie dollar versus the USD. And this market is technically still within range. It was actually one of those markets doing quite good and was trending to the upside. And looked like it was going to head higher at one point. But then you had bad inflation numbers from Australia, and that sort of caused the market to go down a bit. And then you had the strength in the dollar index and the dollar in general, which sort of caused it to move down lower. Now this is a descending triangle, or at least that's how I choose to interpret it. It could technically also be viewed as some funny looking head and shoulders. If I flip it around, so this is all dollar versus the Aussie. Actually, we can't call this head and shoulders. They look a bit like a head, left and right shoulder. It's definitely an ascending triangle. So this is an ascending triangle here. Now, most of you guys obviously are used to trade it like this. So that's just the flip side. And for this in the short term, I think we will probably see a bit of dollar weakness over the next few days, because I think people will probably look to lift this price, book profits, and we're still within a range here, so it might go up, I think, maybe to worst case 71, but I think maybe 70, 60, 70, 74. Now, I wouldn't be doing anything here. Let it go up, and then I think if we take out this level, maybe early next week, I think people will short sell. And this will be a fresh opportunity to add a bit of dollar exposure. Just to give you an idea, if the market sort of would break lower today on this move here, stop loss would just go above that daily high, and then your target would be down here. So that's a 5.5 times reward ratio. So we just need to see what happens over the next few days. Ideally, just trade sideways, because then the longer we spend time here, we'll create a set of highs. This is a good opportunity, or not good opportunity, but good example. We're trading sideways. I don't know if you remember, we said trading sideways, and I said that on a break here, we'll probably head lower, which we did. This is January 1st, and then we had January 3rd, and then you had that flash crash. Of course, in essence what happened, like on the second day of trading, I made some money. I was short, I think it was Aussie dollar CAD. I shorted Aussie dollar CAD on head and shoulders, So you can see this one here. This is a 6 hour. So shorted here and it quickly went down. And then I don't remember. I think it was some yen pair. There's a video on the top of my Twitter page. You see it on the video there. I talk about the two markets I traded, and I was up with about 6% on the second day of the year. Now we're gonna finish off with this and sort of give a bit of a warning. So you can see in regards to this is that we went with the trend, okay? Because the market was going lower, we didn't buy, and that's why we benefited from that flash crash. Most of the flash crash goes with the trend because people get panic. It's the same thing here. We could technically have some sort of a flash crash. The market just goes down because people say, oh look, it's declining, we're losing money, and we need to cut the losses, and then they just exit. You won't usually get hurt by flash. It's not gonna flash like that. I mean, it can, but usually just go with the flow, and that's a benefit of trading with the trend following system. Got a question. Why is the GBP CAD so tricky to trade? So the number one reason why GBP CAD just gets to become tricky to trade is just because there's no strong sort of fundamental trends or in these economies, and people don't have there's no consensus to what's going to happen. So we all know that because of the British pound, it's rather binary. Either they get some relatively good trade deal or some sort of a deal with the EU, and you know, businesses can continue as usual here, and there's not like a huge economic loss, or in worst case there's a hard Brexit, right? And they lose access to their biggest trading partner, and they need to renegotiate things. And the average trade deal takes about 7 years to figure out. So what's happening is that in the short term, 7-10 years, maybe the UK is gonna be underperforming. So it's sort of binary there, and because of that, a lot of people don't want to touch the GBP at all. And then with Canada, it's a tricky situation because you have crude oil prices going upwards quite a bit. That should support the Canadian economy and the Canadian dollar. On the other hand, the central bank is not really ready to increase interest rates. In fact, they were quite dovish at the last meeting, right, which was earlier this week. So that is the issue there. Whereas in the case of the Eurozone and the EURUSD, we know that the central bank is going to introduce teltros that's lent money to banks in Europe that have that it made a lot of sense a few years ago, especially like Italian banks and Spanish banks and banks that had some sort of a problem. The other banks did not want to lend money to them because, you know, they lend the money, but what if they go bust? You don't get your money back. So the ECB set up the teltros, and the idea is there that they can just go to the ECB and borrow money, and they can do that for a very good interest rate. Now that's some sort of monetary easing, according to me. You're adding more euros to the system, right? So most likely, well, they will do something like that. I think they're gonna share that at the next meeting, and maybe introduce. I think in June they said something like that. They're gonna share things like that, and then you have other issues as well, like German GDP. I think for 2 quarters in a row. So since summer last year, it's underperforming, and then you have German IFO figures that were out earlier this week. People thought they were going to bounce to the upside, and people look at the German IFO because it's highly correlated to German GDP, and it did not go up as people projected. So then suddenly it's like, okay, Germany will have a third quarter, if not a fourth quarter, maybe, of sort of bad economic growth. So imagine no growth in Germany for like at least 9 months, maybe up to 12 months. That's sort of the Euro side of things. Then you have the Americans and the US. So obviously non-farm payrolls was 20K, right? That's a bad number. But then you look at the ADP figure, it was never really that low. It was actually stable. You look at initial jobless claims, it was down at levels we've not seen for, what is it, 20, 40, I think 40 years, so 50 years, something like that. It's like never been better. So you have these two important economic indicators telling us that the labor market is good. At the same time, you have wage growth being high. There are other things like retail sales in the US that dropped quite a bit. But yesterday we had durable goods orders, and durable goods orders were actually much better than expected and back up at levels we saw in August last year. So that decline we saw by the end of last year sort of been wiped out. And suddenly, we can check it out. Uh, suddenly, people got really, really dovish, and they anticipated a rate cut by the end of the year. And this was before all that good data. And still, if we look here for the December, this is the December 19th, December 11 meeting. So this is the current rate as is at between 225 and 250 basis points. Now, there's just a 30% probability of the interest rate staying at that level. That's what the market is projecting. So 100 minus 37 and a half. Sorry, this calculator is terrible. Say 60%, 63% probability. That's what the market thinks. That with a 63% probability that the interest rate is going to be lower, that they would need to cut at least once. There's like a 40% probability that they're going to cut just once, and a 17.5% probability that they're going to cut twice, and then you have a 3.6% probability that they're going to cut at least 3 times. So the market here is extremely, extremely dovish, and it just takes maybe another good month or two of good data, and then suddenly all this sort of shifts away. Maybe this is going to be at 25%, and if the Fed says in 3 months from now, look, the data is holding up well, we might increase interest rates, then suddenly everybody sort of needs to backtrack on what they've been saying and doing in these markets, and the dollar would probably rise quite significantly. In fact, the Federal Reserve themselves, they are anticipating to increase interest rates at least once this year. Now, who controls the economy of the U.S.? Well, it's not the markets. It's the Fed, right? Depending on how they manipulate interest rates, they will get where they want to. That's why the Federal Reserve has the best track record in for the economy. They also have a huge amount of money and very clever people over there in projecting where the economy is going to be. So the U.S. Central Bank is the best forecaster of the U.S. economy, and they're holding the tap, so to speak. They can decide when to cut and lower interest rates. So of course, they're gonna hit their target easier. So those guys are saying we're gonna increase interest rates at least once, and you know how the market changed their moods, right? Just 4 months ago, everybody was panicking. Well, what's gonna happen in the next 4 months? Maybe everybody's gonna be super optimistic again. Maybe they're right, maybe they're wrong. I'm not sure, but cutting interest rate 2 times this year, I think that's unlikely. So from that perspective, why is not the euro dollar much lower? In fact, people have done analysis, and like macro guys have done analysis, and they say, given the divergence in the economy, the euro dollar should already be trading here at 109. It should not be sticky at these levels. So from that point of view, it makes sense that this goes down, but obviously not that easy to trade. And you can't really say that about GBP/CAD because of Brexit. And again, that makes situation where the central bank is dovish, but then crude oil prices are higher. So that's a very lengthy explanation to why the GBP/CAD is stuck there. I have produced a quarterly report, which is going to be up relatively soon. Let's see if I can find it. Of course, I can't find it when I need it. But we produced a quarterly report for ATFX. That should be up in the next, I think they're just working on the page so people can download it. That should be up most likely, I think this time next week. And that gives you a nice little overview of the UK economy, the US economy, the Australian economy, and I think a few more countries as well. Here we go. I have found it. This is the Q2 report. We started really late, that's why we're doing it late. But yeah, dollar, GBP, Euro, Aussie. I wrote these sections here. And then we have the team in Hong Kong that wrote these sections here. And the Dubai team wrote these sections here. And then this is split up. So we have some more content here, and I'll be able to send you this link so you can download this report maybe this time next week. Okay, guys, we're going to wrap things up. Don't forget to like the video. We have 5 likes so far, so we're not doing too good, guys. Don't forget to like the video as well. If you can share it, you're most welcome to share it. You can share the link. You can share via Facebook, Twitter, and so on. Let's get this show trending. Let's see if we can help other people as well to do better in the trading. Thanks so much, and I'll see you guys on Monday for the next market update. Thanks.